Welcome to the Serenity Wealth Now show with Chris Cooper. This is not your typical financial show. As a CPA, licensed insurance agent, and investment advisor, Chris brings the financial conversation to life, where the numbers really matter. Every week, Chris sits down with someone from the community to find the financial lessons hiding in their story. Now, here's your financial friend, Chris Cooper.
Good morning. All right, so we are going to do something a little bit different today. We are going to talk straight up finance, and I got a fellow finance friend with me today, David Cleary, Fortis Capital Advisors. How are you, David?
Doing great, Chris. Glad to be here.
David's been on with us before. David is the Chief Investment Officer behind Serenity Wealth, behind many other advisors that help and support the entire Fortis Capital Advisory Network. It's a big, big job, big shoes to fill, and David does it really, really well.
Thank you, Chris. Very kind.
Well, you also have a pretty good team on your helping out as well.
It's not a job you can do yourself.
That's right.
You need a lot of help because there's a lot of things to think about.
Well, and the markets are a little bit crazy, and you know, Q1 we started off the year after a very volatile year in 2025. Now, I still have a hard time saying 2026. I don't know how you feel about that. Are you ready for that yet?
Yeah, I finally got over it.
Yeah, well, yeah, I guess once you file your tax return, you can really.
Yes,
2025 is officially over. You know, but you know, quarter one, people were a little bit distraught because we have seen so much growth over the last almost 4 years. Right? It's kind of like we're on this great pathway. Is it our expectations, or is there really something that we need to think about and worry about for 2026?
Well, there are always things to worry about. And, you know, I think looking at the first quarter, you have to remember that January, February were strong months, right? And so the kind of the economic trajectory that had occurred, particularly in the back half of 2025, definitely followed through into 2026. Expectations were high for economic growth. The earnings trajectory was very good. But then, you know, we had, you know, the war in Iran started.
Yeah.
And that created an enormous question mark as it applies to energy markets and ultimately, you know, what higher oil prices are going to mean for the global economy and the U.S. economy.
Well, and it created another conversation that we kind of, I can't say forgotten about, but, you know, we've kind of gotten used to it, is that inflation conversation, right? And whenever you see gas prices, it does have an impact on how, even if it's real or not, but how we feel about inflation, because every time we go to the gas pump, we feel that inflationary pressure on our live environment scale right there.
Yep. Listen, the demand for gas is pretty inelastic.
Yeah.
You got to drive to work. You got to live your life. It's, you know, you have to get gas. And what happens is higher gas type prices act as a tax on the economy. Yeah. Right. So it's just taking money away from something else you would have done. Go to dinner on a Friday night, you know, go to the mall, or I should say, go to Amazon and buy some discretionary items. You know, you may not do that because, you know, oil prices, you know, gas prices are now, you know, $4.20 gallon.
And you feel it immediately, right? I mean, it's just crazy because you get a conflict in the Middle East, and then all of a sudden, 2 days later, you feel like you're paying higher prices at the pump, right?
Yes.
And I'm like, that there's no way that it took just 2 days to get from over there to over here, right? But that's not how the market works.
No, market operates on the newest piece of information, not the average piece of information.
Yeah, and it goes both ways, right?
Indeed.
We're only going to talk about it when it affects us negatively.
Yes, that's right. You know, if we get complete resolution in the Middle East, and oil prices go back to where they were, gas prices go back to where they were.
Yeah.
You know, you're right. It'll be a blip in the news cycle.
That's right. And it doesn't seem like we've seen a lot of gas price decline, but conversely, with the conflict in the Middle East, we have seen some craziness in the financial markets as well.
Mm-hmm.
You know, but those concerns seem to have kind of alleviated, at least from a perception basis in the market.
Yeah. Well, what we said on the onset of the conflict in Iran was we were due for a correction. And every time you have a correction in the marketplace, the cause of that correction seems very unique and very scary.
Sure.
And in this instance, it was a war in Iran, right, against a true geopolitical adversary. So that in and of itself is scary. And then you factor into all the ramifications around oil, energy prices, gas, which we just touched on. So again, it becomes a big, big question mark. So the stock market sold off a little over 9% from its all-time high in February to March 30th, and finished the quarter down about 4.5%. And so
obviously we haven't seen a down quarter in a long time either.
No, we had not. First quarter of 2025, right? When we were first starting to contend with the whole tariff regime.
Oh
right?
my gosh, tariffs. I forgot about that word.
Yeah. It's amazing how quickly we forget. That's exactly right. And so we chalked it up that March was a correction, and that there still was a fair amount of good news embedded in the economy.
Yeah.
And what's also important to note is that we are no longer, the U.S. in particular, but the world as a whole is no longer as energy dependent, as oil dependent as it was 30 or 40 years ago.
Yeah.
I'm old enough to remember when Iraq invaded Kuwait. It was a big deal. It was a really, really big deal. And because the impact of the energy sector was so much more important than it is today. And so people, to your point, quickly started reading through this, right? And started saying, okay, oil prices now, $100 a barrel, problem, but manageable problem.
Right.
Particularly in light of the fact that the war itself was very one-sided.
Yeah.
Put it that way.
Well,
right?
Very swift. Now there's, talk about the strait opening, being shut down, all the different things, right? But the markets seem to go, okay, whatever this is now somewhat at least under control, at least from a perception basis, right?
Yep.
Now that could change tomorrow.
Absolutely. And listen, there are very, very few people around who are going to say, you know what, the Iranians were good guys. The mullahs, they were great.
Yeah.
Very few people are going to say that. And I think if you get a global bad guy off the scene, that's good news for everybody.
I tend to think so as well. And that's, and I'll even go back to the old, the Bush time frame when it's like, oh, where's the proof? Where's the proof? I'm like, I don't necessarily, in my opinion, and this is all personal opinion, right? Forget markets, all the other things, right? Worst case scenario, you get a bad guy off the table. Some part of me is at least okay with that, as that's a win in my ways, right? So, look, I think that this is even worse than that situation, because I think there is real proof that there has been some developments on the nuclear side, which is very scary for the world. But it's going to create chaos in the markets, and investors need to understand that. And that's part of that whole thing that we always preach, is that diversification and making sure you're comfortable with the long, wild ride that is going to be there.
Indeed. Diversification has really bailed out your average investor through this downturn, this most recent downturn, as well as the downturn from a year ago around tariffs.
Yeah.
Because we saw international stocks do well, in really throughout both periods. Small cap has done well. Very Interestingly, however, fixed income in this downturn, in the March downturn, did not do well. Bond market was off about 2% for the month, and that was a bit of a surprise, because typically in geopolitical conflicts, people rush into treasury securities, drive down interest rates, and they want that safety. And for whatever reason, that didn't happen. Possibly fiscal concerns.
Yeah, that makes sense. And I think that actually is interesting with some of the, I don't know if rhetoric's the right word, but it's common in today's world, right? We're hearing that all the time, but there's a lot of conflict between the administration and the Fed, right? And how interest rates work and all that kind of stuff. And I keep wondering if that has something to do with that as well, just monetary.
Yeah, absolutely. Right. So we're going to get a new Fed chairman, Kevin Warsh, and we don't know what Kevin Warsh, he had testimony last week, which seemed to go well.
Sure.
But you won't know how Kevin Warsh governs as as head of the Fed until he's head of the Fed.
Right.
Yeah, I think his nomination will be approved, and he will be the next Fed chair. And his reputation is good. He's he's a bit of a Wall Street insider, and I mean that in a good sense for this job.
Yeah.
Because it's understanding the plumbing, not just of the Fed, but of how Wall Street works, how the economy works. That is important variable in any Fed governor.
Absolutely. Well, and I just think interest rates are a very interesting thing because it's a fuel that can spur economic growth, right? I mean, it ultimately how we are able to borrow monies affects businesses, and it gives us the ability to sustain growth in an investment in infrastructure, and not just for larger corporations, but also the small businesses. And that's really a key that is often overlooked, is that growth in the small business environment.
Yeah, indeed. Yeah. The concern by some people in the Senate last week was that Kevin Warsh will not be an independent Fed chair. Is that that Trump will be driving monetary policy? I don't believe that will be true. I think in the end, Trump will do what he does to everybody about everything. He jawbones what he wants, but in the end, I think Kevin Warsh will be an independent voice, and that's as Fed chair.
Right. I mean, that is good. And as much as I like to have certain sways, I do like less government overall. And I like less.
Indeed.
There's a reason, there's a reason why we have so much. It's a lot of red tape and bureaucracy to get things done. And some people and I'm guilty of it too. I complain about how difficult the government is to work with. But at the end of the day, I'm kind of like, you know what? Good. Because that means it's hard to do things. And I actually want that. Until you want the government to do something, then you're frustrated by how slow and inefficient they are, right?
Yes, that's right. That's right.
But that's okay.
But to you may get your wish here, because Kevin Warsh appears to be committed to reduce the size of the Fed balance sheet, right? Which expanded out dramatically on the back of the global financial crisis in 2008, and expanded again as a function of the COVID crisis in 2020. And so Powell has been whittling it down. Kevin Warsh may be more aggressive on this trajectory of reducing the Fed balance sheet.
Yeah.
Which,
well, now,
to your point, would be a good thing.
Yeah, it would be a good thing. And speaking of kind of the balance sheet, let's just think about the balance sheet overall for the U.S., because it's hard to overlook the level of our national debt. And it is just becoming that much more alarming all the time. And what concerns do you have on that side of the fence?
40 trillion now, if I read correctly, is the total.
I remember talking about 37 and 38 like not that long ago.
Yeah, that's right. And
I think I had a slide at 35 trillion within the last few years. So scary.
Trump's adding $1 trillion, I think, to the debt every 6 months or so. Right? He's not a tax and spend politician. He's a spend and spend politician. Right? A borrow and spend.
Yeah.
And it's showing
that's the real estate background, right? That's what.
Yeah. Oh, absolutely.
That's totally what you do.
Extend and pretend. Yeah. I was at a conference in the first quarter, and Scott Bessent spoke at the conference, and he was very interesting because what he stated was what we all know, is that the federal debt is way too high, and he said two things: federal debt's too high, and affordability issues are real, right? Due to the last bout of high inflation, which we had in 21 and 22. He says, but the best way to solve that is to faster economic growth, right? People making more money so they can earn their way into higher prices on the affordability side, and then the government can begin to draw down, again, that deficit.
And it's real hard.
Could be wishful thinking, but we'll see.
That's my whole concern. I mean, you mentioned, the current administration spending a lot more, but the math behind what we spend money on in this fiscal government is so high on really mandatory spending no matter what we do, right? I mean, you've got interest rates, which are high. So therefore, you're going to spend more money on servicing the debt that is growing. You've got your discretionary spend, which, let's call it 2 trillion amongst friends here, right? It's ballpark there, and growing, sure. But that's what Congress is bickering about, is that how to spend that 2 trillion. The big elephant in the room is our social programs, Medicare, Medicaid, and Social Security. And those programs are failing and growing, and we can't really do anything about it because if you talk about them, they're political suicide. That scares me also.
Yes. And no one seems to have a real solution.
No.
On the non-discretionary spending.
You don't want to cut benefits. No one does, right? That's political suicide, by the way. And plus, I wouldn't want to sit across from my clients and talk about how your Social Security is about to get cut, right? That's not great. You could pass it to the next generation by increasing the full retirement age. I think that that's been done in the past, and many would argue, and probably myself included, it feels like it should have already been done to some degree as well. Like, we're living longer lives. It wasn't supposed to last as long as it's lasted for life expectancy. We probably need to do some of that stuff. But this whole cap conversation, people don't think about that, raising the cap with what that means. You raise the cap, you also raise the amount that people benefit as well. You can't have it both ways. And so I think people lose sight of that.
Yeah. No, but it's a quandary that no one really seems to have a good solution set around.
No. And when you're already in the hole based on just servicing your debt and your mandatory spending, basically any spending you do as the government is going to put you in a deficit, which is going to increase your debt. So then it gets into that whole equation of good debt versus bad debt, right, David? And that's kind of what you're talking about with the speaker you heard is all problems get solved when you make good financial investment decisions and have the ability to have healthy debt that outpaces economic growth.
Yes.
Are we seeing that?
Well, with the Iran war, growth expectations in the U.S. went from, call it 3% to 1%.
Yeah.
Again, that tax of higher energy prices on the economy. It's still positive. That's good news, right? I haven't seen anybody project a recession quite yet. So that is good news. And the very important point is, we are no longer an oil importing country. We are an oil exporting country. And there are incremental benefits we get out of that. But higher energy prices, particularly higher gas prices, again, are a tax on the economy. And so it will have its slowing effect. And that, to your point, is just delays anything constructive we would see happen on the debt side. Right? If the economy's not growing at 3+, then you just can't afford to bring down your debt.
And the answer is not like this whole crypto thing. I've heard rumors about like crypto doing all this stuff. I'm like, no, I don't think that that's helpful at all.
I don't know. I hear the same rumors, and I don't view it as a solution. Maybe I don't know enough about it, but I don't
it scares me personally, and I know how you feel on that one too. So, so obviously, I think you also hit on something a while ago too. We lose sight on Q1 was more down, but also off February all-time highs, and we forget about that. We are just so short-term, short-sighted in today's crazy social media-driven world.
Yes. Well, we are now at new all-time highs, right? And so it didn't take a long time to get back on track.
As of the time of this show, at least. I mean, if you're listening to it afterwards, who knows where we'll be? But it's so volatile today,
Yes, that's right.
No, and that's another interesting topic too, David. Have we seen like the volatility? Really, the steep declines and then the speed of the recoveries is also something that I think is very unique in today's society. And I just don't know in other history of time that we've seen that kind of environment.
Right. Well, I chalk it up to investment markets have never been more democratic, right? So investors of all shapes and sizes can access virtually any investment idea just through an exchange traded product.
Sure.
And so, you want to trade copper, all right? There's an ETF for that, right? And I'm a big advocate of ETFs, but it has brought an element of participation and volume and volatility to more niche sectors.
Sure.
And we have a gambling culture in the United States, right?
Every sports team now, it's like encouraged, right? They're sponsored by. Remember, Pete Rose is in the Hall of Fame because of this.
Yeah, these are all,
It's true.
So everybody's looking to make a quick buck on the up or on the down, which contributes to the volatility. But what I would add to that also is that single stock volatility has been extraordinarily high. Anybody who owns individual names has probably experienced a big pop on the upside or on the downside.
Yeah.
And some of the names you own, sometimes on virtually nothing, right? It's and that part has become challenging for investors also.
Is that just how easy and just information is out there in today's world too? I mean, it's got to be part of it, right?
Yeah.
And we're so headline focused. I think we're headline focused, not focused on the actual content of the article,
Yeah, some of that. I mean, I'm going to pivot back to earnings several times on this call because it's the most constructive data point that I see in the investment spectrum right now. But you see this all the time in stocks. Company has high expectations going into quarterly earnings. They exceed their expectations, and the stock goes down 12%.
Right.
Right. So, why is that happening? Old SOV, buy on the rumor, sell on the news, or just kind of the skittish nature of all types of investors.
Yeah.
Right?
Makes sense. Yeah, absolutely makes sense. So, where do you think we're going to go? Like, what looks strong? I think the economy does look overall pretty strong, right?
If anything, I think the last 30 days shows you how resilient the U.S. economy is.
Yeah.
How resilient earnings trajectory has been. We don't have charts on this call, but this is what the large cap earnings chart looks like. The forward earnings chart. Yeah. It is very, very steep. And what corporate America has proven over the last, whether it be through COVID and beyond, is they execute on the thesis of making money at the corporate level. Sure. and benefiting shareholders. And so, I believe that culture is very much in place. I see execution across the economic spectrum. And our expectations are still fairly bullish.
Yeah. Good.
Right? So that's good news.
We like to see that. We like to hear that. Now, just to play one devil's advocate on a metric that I've heard, and I think this is the most concerning economic metric out there. Am I right here, David? Jobs reports feel a little bit on the downside.
Yes, they've been volatile and concerning. There's a churn going on in the economy, and a lot of it is centered around AI and information jobs, and particularly for young people. Why hire a junior analyst when you can get one for $20 a month? Sure. Right.
Yeah. Now, is there anything in the jobs data that you've heard? So one of the things that I've heard is some of the jobs data would suggest that, some of this is just government jobs a little bit on the declining nature, which kind of skews the overall metrics, but actually helps other metrics in some ways as well. Right.
Yeah, yes. We are the federal labor force. Federal government labor force is at its lowest level since the mid 1960s, right? And so, government is large, as we just talked about, and there has been a definitive reduction in terms of the headcount in government. And like you said, what happens? That obviously has an impact on the month-to-month labor reports. And where do these people go? How do they get kind of recirculated into the economy?
Yeah,
don't have deep answers on those, but back in terms of the size and scope of government, I think that is a constructive step.
Yeah. overall. It's going to hurt you on one metric, but potentially it has other ramifications that might be better, especially if you believe in a less government type of an approach.
Yes.
It depends on what your view is. I do as well. So, guilty. I'm okay with that. And and all those things do kind of make sense, but it's interesting. All of these things are really connected, and there's a lot of emotional things in there. So how do we need to encourage people to take some of that emotion away?
I was on a call recently, and someone asked the same question: how can we continue to look at the the investment landscape in a constructive sense when you have these problems and data points, when you have Iran, when you have and again, one of the old saws on Wall Street is the market climbs the wall of worry, and you have to keep that in mind because it does, right? Expectations fall. And that just makes stocks more attractive, right? So we started the year with the S&P 500 trading at roughly 22, 23 times forward earnings. It got as low as, I think, 19 times back in March, right? That was a real, kind of cut in valuation. So you couldn't, it was harder to say, I don't like the stock market anymore because it's rich, because it was no longer rich.
Right.
And then you look at, kind of the tech sector, particularly large cap growth companies, they were trading, let's call it 30 times forward earnings. Tech is trading at, kind of 10-year lows now on a forward earnings basis. And so people are now starting to, recirculate back into the tech space. And so again, each economic environment presents opportunities for you, right? Yes, there's always stuff to worry about, but what I said to the person who was concerned about the macro environment, I said, if I'm only going to pay attention to one chart, I'm going to look at this earnings chart. And when that rolls over, and I say, okay, things may be changing, but if companies continue to execute on an earnings basis, stocks can continue to run.
There you go. Well, that makes sense. I think that's good to hear, right? It's because it's so easy to get so inundated with the headlines and the emotion, and there's a lot of good fundamental things that we're still seeing. I know you guys spend a lot of your time focusing on trying to understand that why. What's driving it from a real fundamental perspective on an individual company basis, but also on an economic perspective as well. Without the crystal ball approach, because obviously that's we'd all be doing this for different reasons if we had that. But it's all great.
It's again, you just got to parse through a lot of stuff and kind of hang your hat on a certain set of data points.
Yeah.
Like I said, right now the earnings trajectory is amongst the most positive.
We like to hear that. So, all right. Well, that's a good way to start the year off, even though we've had some turmoil. Long-term approach still looks intact. Keep diversified, I think, is the key message there, right? And
stock market's up 5% for the year at this point.
I mean, geez, you can't complain about that.
And again, there's always stuff in the middle.
Year, right? We still have to do math on that 5% at this point, right?
Yes.
It's different when you're in December. We're not. This is not a bad place to be. So,
yes.
Awesome. Well, David, thank you so much for joining us today. We're going to do this every single quarter, talk a little bit about this, what's going on in the economic environment and what we can do to help people feel a little bit better about where we are in today's world. So thanks, David.
Thanks so much, Chris.
Folks, it's easy to get hung up in the headlines. We get headline fatigue. We get scroll fatigue, right? We see that crazy hot item that just throws up on our Facebook feed. And what do? We get sucked in. We get panicked. And then we start just trying to digest little bitty bits and pieces. It's really important to take a step back, read the full article, understand why the content exists and what is really driving the fundamentals behind the headlines. That's when you start to see how the big picture comes into play. That's when you understand the long-term ramifications and making sure you make good, solid decisions about your financial future. And that's true really in general advice, but it's that much more important when we're talking about an investment portfolio. These metrics matter. These little things like the jobs report, these little things like the economic growth and all the different data and the metrics that support what's going on from an economic perspective and company earnings reports. These are big things. And we want to make sure experts understand how to analyze them so that we can take emotions out of the equation. We are an emotional species. It is just who we are. And that gives us a lot of great, beautiful attributes. But it also makes us very easy to manipulate and get our heads in our own way when it comes to investment decisions and the ability to panic in potentially negative markets and negative situations. We need to make sure we take that step back, take a deep breath, and think about what's driving these decisions so we can make better, more educated, long-term decisions. And I'm not saying take risk. I'm not saying pull back and remove yourself from risk. I'm talking about educated risk. I'm talking about reasonable risk. I'm talking about making sure you understand what's important to you and the amount of risk you're able to take, because it's different for everybody. I talk to some people and they're so risk adverse, they just don't want to see any losses, right? They don't care if they gain money. They just don't want to see if they just don't want a single dollar of loss. I talk to other people and they're like, yeah, I'm down today. It's fine. No big deal, right? They would be more upset losing out on opportunity. The market outperforming what they could have done, right? Versus what they did do. So you got to be more aggressive in that mindset. And that tends to not necessarily change because that's innate in who we are, right? But we have to make sure our income's protected. We have to make sure we understand how to live our life no matter what, right? Because selling at a loss, that's when it really gets you. So stay tuned each and every week. Serenity Wealth Now for great fun with finance and wonderful information as well. Tune in each and every week, NewsTalkSTL, or check us out on Serenity Wealth Now social media outlets. See you next week, folks.
Serenity Now!
Serenity Wealth Now can be found wherever you are at SerenityWealthNow.com, on YouTube, Spotify, LinkedIn, and Facebook, and on NewsTalkSTL Sunday mornings at 9 a.m. When you're ready for your own conversation, schedule some time with Chris by visiting SerenityWealthNow.com. That's SerenityWealthNow.com.
Investment advice offered through Fortis Capital Advisors.